A lot of margin, more than most other traders, but how much is too much? Our guest is here to talk to us about that today, Wayne McDonell. Wayne, thanks for being here.
Thanks, Tim.
Well, we hear about offering 400 to 1 margin, 100 to 1 even 10 to 1 is a lot for some people. What do you recommend to keep our risk low for new traders especially?
Well, you're right. New traders are usually way over leveraged, and you know, it's exciting. I mean, it really is, especially to an amateur trader where for a few $1,000s you're trading hundreds of thousands of dollars, and if you're lucky enough to win, the leverage works for you. But what they don't realize is more often than not, as an amateur trader, they make mistakes, and that means every mistake they get is leveraged. If they're trading outside of the United States, yeah, it's true. Some traders are trading at 400 and 500 to 1. It's crazy. It's absolutely insane. Here in the United States, if you're trading the major currencies, you cannot trade any more than 100 to 1. Futures are only traded at 30 to 1 or something to that effect. So even 100 to 1 is a lot of leverage. But what people have to understand is that you need to trade a lot of money, because I'm only trying to get 1/4 of 1 penny out of the market at any given time. You know, 1/4 of 1 penny isn't a lot if you're not leveraged. But if you are leveraged and you manage the leverage, you know, appropriately, then you can still have these favorable risk-reward, you know, opportunities. But an amateur trader, though, very often comes to the market and they're thinking they have the possibility of making millions of dollars very, very quickly. They see hedge fund managers getting paid $250 million a year to trade, and they want that excitement and that access to that potential. But what they don't realize is those professionals that make huge sums of money, they don't use high leverage. They're not trading at 500 to 1. Also, amateur traders are trying to get, you know, 25% return on investment every single month, you know, which is crazy if you think about it. Professional hedge funds, and these are the best of the best, the professional hedge funds that trade Forex, they return on average 2.5% per month. They're not doing 100% return every month. And so if you put all the math together, a new trader trading at 100 to 1 leverage is usually over leveraged, and they need to relax a little bit. They need to slow down, lower the lot size, and realize the secret to success is trading successfully on the long term in a conservative fashion, and let compound interest make you rich and not gambling.
And on the other side of that, you have people that can even open an account for as little as $50 or $250, which is still a very little bit of money, and then have the 400 to 1 margin. I mean, in one trade, in less than a few seconds, you could be gone.
Right, and again, the secret to success in Forex is being able to sit down every single day and take in conservative trades for years and years and years. That's the secret. Like I always say, if you're sweating bullets over a trade because you're so nervous and so upset, you just have to get this trade to work, then you're not trading properly. You should have such low leverage and trading such a lot size compared to how much money you have in your account that any given trade is really not that important, or any given trading day is not that important. I'm a professional trader. I have bad days, but it doesn't ruin me. And I think that's where the amateurs make mistakes. They're putting too much money on the line with not enough information and no patience and discipline, and they lose because of that. But not necessarily just because in the United States we're limited 100 to 1. It's because they're just making amateuristic mistakes.
Wayne, thanks for your time.
My pleasure, Tim.